Imagine a world where every dollar you earn not only sustains you today, but also builds wealth for tomorrow. Robert Kiyosaki, renowned author and investor, unveils a path to financial independence through mastering 6 fundamental rules of investing. These rules aren't just about numbers. They're about reshaping your mindset and seizing opportunities that traditional advice overlooks. So, if you're ready to shift from merely earning money to creating lasting wealth, stay tuned as we dive deep into these essential principles that could redefine your approach to investing and financial freedom. But before starting, don't forget to hit that like button and subscribe to our channel No Money for more amazing content. Now, let's begin. Number 1. Understanding types of income.
See, there's 3 kinds of income: earned, portfolio, passive. So earned income is if I get a job, that's earned income. If I'm a doctor or a programmer, that's earned income because I'm working for it. If I buy, let's say, Apple for $10 and I sell it for $20, that's portfolio income, capital gains.
Yeah.
But passive income, which is cash flow, is never taxed.
Income isn't just money earned. It's a pathway to financial independence. Robert Kiyosaki distinguishes between 3 fundamental types of income: earned, portfolio, and passive. Earned income, derived from a job, is the most familiar, but also the most heavily taxed and time-constrained. It forms the foundation for many, yet often limits financial growth due to its dependency on continuous effort. Portfolio income, from investments like stocks and bonds, offers potential growth, but is subject to market volatility and taxation, making it a moderately challenging avenue for wealth accumulation. Kiyosaki's preference lies in passive income, generated from assets such as real estate, royalties, or business ventures. This income is less taxed, benefits from various deductions, and crucially, doesn't require constant active involvement, allowing for financial freedom and scalability. Understanding these distinctions is pivotal in reshaping one's financial strategy from merely earning money to strategically accumulating wealth. By focusing on passive income, individuals can shift from a labor-intensive income model to one where assets generate continuous cash flow, laying the groundwork for sustainable financial security and independence. Number 2. Converting ordinary income. For many, receiving a pay raise or bonus prompts thoughts of increased savings or contributions to retirement accounts. However, Robert Kiyosaki advocates a different approach: converting ordinary income into assets that generate passive income. This strategy shifts the focus from merely accumulating savings to creating enduring wealth through strategic investments. Kiyosaki's philosophy challenges the conventional wisdom of saving for the future by advocating for immediate deployment of additional earnings into cash-flowing assets. By paying oneself first and channeling income into ventures that produce passive returns, individuals can accelerate their journey towards financial freedom. This approach not only diversifies income sources, but also mitigates the risks associated with relying solely on earned income, which is vulnerable to economic fluctuations and taxation. The key takeaway is to view every increase in income as an opportunity to strengthen financial resilience and independence. Converting ordinary income into passive income-producing assets aligns with Kiyosaki's belief in leveraging assets that work tirelessly to generate wealth, regardless of personal labor input. It's a strategic pivot towards building a robust financial portfolio that endures and grows over time. Number 3. Investor as asset or liability. In the world of investing, the distinction between success and failure often hinges on the investor themselves. Robert Kiyosaki challenges the notion that investing is inherently risky by asserting that it's the investor who dictates outcomes. Whether one becomes an asset or liability in investment terms depends on their level of financial education, experience, and mindset. Kiyosaki emphasizes that a good investor isn't simply someone who picks winning stocks or ventures. It's someone who continually invests in their own financial intelligence. This ongoing education allows investors to make informed decisions, navigate market complexities, and capitalize on opportunities that others may overlook. Conversely, a lack of financial education can turn even promising investments into liabilities. Without understanding market dynamics, risk assessment, and strategic planning, investors may expose themselves to unnecessary risks or miss out on lucrative opportunities. Kiyosaki encourages aspiring investors to start small, gain experience, and build confidence through practical learning experiences. Ultimately, viewing oneself as the primary asset or liability in investing is foundational to achieving long-term financial success. By prioritizing education, staying informed, and adopting a proactive approach to investment strategy, individuals can position themselves as astute investors capable of navigating the complexities of the financial markets effectively. Number 4, the importance of preparedness. Preparedness in investing goes beyond mere prediction. It's about being equipped to seize opportunities when they arise. Robert Kiyosaki underscores that many investors miss out on potentially lucrative deals due to lack of readiness, whether financial, educational, or emotional. Financial preparedness involves having liquid assets or access to financing readily available. It means understanding your financial position and having a clear strategy for deploying capital. Educationally, being prepared means continually expanding your financial knowledge and staying informed about market trends and investment opportunities. Emotionally, preparedness involves maintaining discipline and composure during market volatility, making decisions based on logic rather than fear or greed. Kiyosaki emphasizes the importance of foresight and agility in seizing investment opportunities. Prepared investors not only recognize good deals, but also have the resources and mindset to capitalize on them swiftly and decisively. They leverage their financial literacy and network to navigate market fluctuations and position themselves advantageously. By prioritizing preparedness, investors mitigate risks, maximize returns, and build a robust foundation for long-term financial success. In essence, preparedness isn't just about being ready for what's predictable. It's about readiness to adapt and thrive in an ever-changing investment landscape. Number 5, attracting money with good deals.
And there were one more asked me, said, what's the best investment? Because real estate's coming down, stocks are coming down. And I held this, I held it up. And the little women, they were all tithers. Oh, I should invest in that? I said, yes. Give me this. So they looked at me and said, give you $3 for that? I said, yes. And their brains went, why would I give you $3 for that? I said, okay, give me 2. And their brains are going, why would we give you $2 for that? This is pre-64 silver. Lynette Zhang, she's also from Arizona, she's numismatic. So I was holding this up like this, and they went, they're all intimidating. They forgot to serve my coleslaw. They said, why should we give you $2 for this? I said, because it's worth this.
According to Robert Kiyosaki, the ability to attract money with good deals hinges on credibility, competence, and a solid track record. When investors consistently demonstrate their ability to identify and execute profitable investment opportunities, they naturally gain the confidence of potential partners, lenders, or investors. This credibility is built through a combination of financial education, practical experience, and a proven ability to generate returns. Networking within investment circles also plays a crucial role. Establishing relationships with like-minded individuals who share similar investment goals can lead to collaborative opportunities and access to additional capital. Kiyosaki advises aspiring investors to focus on building a reputation for reliability and expertise, which enhances their ability to secure funding for larger and more ambitious projects. Ultimately, attracting money with good deals is about showcasing competence, integrity, and a strategic approach to investing that inspires trust and confidence among stakeholders. Number 6, evaluating risk and reward. Evaluating risk and reward is a cornerstone of successful investing, according to Robert Kiyosaki. It's not just about avoiding risk, it's about understanding and managing it effectively. Every investment carries inherent risks, whether it's market volatility, economic cycles, or specific business risks. However, Kiyosaki advises that risk should be viewed in context with potential rewards. A prudent investor evaluates each opportunity based on its risk-to-reward ratio, weighing the potential returns against the level of risk involved. This assessment requires thorough research, financial analysis, and sometimes intuition honed through experience. Kiyosaki encourages investors to diversify their portfolios to spread risk and maximize opportunities for returns while staying vigilant for asymmetrical risk-reward scenarios where potential gains far outweigh potential losses. By mastering this evaluation process, investors can make informed decisions aligned with their financial goals and risk tolerance, fostering long-term wealth accumulation and financial security. In conclusion, mastering these 6 basic rules of investing isn't just about accumulating wealth. It's about cultivating a mindset that empowers financial independence. Robert Kiyosaki's insights challenge traditional financial advice, advocating for proactive wealth-building strategies that prioritize cash-flowing assets and strategic investing over passive savings. If you found this video informative, then don't forget to hit that like button and subscribe to our channel, No Money, for more amazing content. Thanks for watching, and we will see you in our next video.